In this section, we're going to talk about managing short-term assets. Short-term assets really come in three buckets, three large buckets. You've got cash and cash equivalents, you've got accounts receivable, and you've got inventory. So we'll dive into each one of those. There's three basic alternative current asset investment policies. You can have a relaxed policy, a restricted policy, or a moderate policy. We're going to talk about each one of these in a little bit of detail, but generally know that most companies kind of lean toward one of these three. In a relaxed current asset investment policy, there's relatively large amounts of cash and marketable securities and inventory, so you generally have quite a bit of buffering cash and inventory. Sales are stimulated by a liberal credit policy that results in high level of receivables. So you essentially go, I want to drive sales. How do I drive sales? Well, I'm going to provide very attractive credit terms, so maybe 0% financing for 12 months. And so as a result, you've got a very liberal credit policy with high receivables. And in order to do that, you need to maintain high levels of cash and investments because you're not collecting the cash as quickly. If you have a restricted policy, holdings in cash and marketable securities and inventories are minimized, and that also means you're probably getting paid in cash. So you don't hold a lot of cash, marketable securities or inventories or accounts receivable. And then a moderate, which is how most companies operate, which is between relaxed and restricted, where you are balancing all those elements. This is just showing that in graphic form. If you had a relaxed current asset policy for 100 million of sales, you may be holding $30 million of current assets. Moderate 23, restricted 16. Again, this is going to be because your cash, inventory, and accounts receivable are low. This is going to be because your cash, inventory, and accounts receivable are high. Cash is a lifeblood of any firm, and the goal is to minimize the amount of cash the firm must hold for use in conducting its normal business operations, but it's got to be sufficient to pay creditors, maintain its credit rating, and meet unexpected cash needs. The reason you want to maintain a minimum amount of cash in the business, balanced against those three factors, is because cash really generates a very low rate of return. It's an asset that just sits there, and if you're getting interest on it at all, it's going to be very low. And so the argument would be made that if you have excess cash, it should be distributed to shareholders, should be invested in a high IRR or net present value project, or used to pay down debt, but it shouldn't be just sitting on the balance sheet collecting dust or earning 1% interest. And so your goal as a cash manager is to minimize the amount of cash on the balance sheet, but balance that against the need to pay creditors, maintain your credit rating, and meet any unexpected cash needs and have a reserve. There's a few reasons why you might hold cash. Cash balances are necessary for day-to-day operations, and you're going to need to maintain a transactional balance to handle the puts and takes or flows in and out of your bank account of the cash that's necessary to keep your business in operation. The other one is, as we had mentioned or the last chapter, you may need to maintain a compensating balance. That's going to show as cash on the balance sheet, and that's a deposit to meet bank loan requirements. It's just sitting there. You saw what that does to the cost of borrowing, but if you do have a compensating balance, that means you're holding cash. You're probably getting almost zero in the way of return, but you're paying interest on it. You may also want to maintain a precautionary balance, which is your reserve for unforeseen cash needs. The other thing that a lot of people do and a lot of businesses do is they maintain a line of credit instead. So they may have a line of credit, an unsecured line of credit at the bank, or if this is your household, you may have a credit card that you use for emergencies, or a home equity line of credit that you use for emergencies, as opposed to utilizing cash in a savings account. And then you've got speculative balances, which are cash balances that are held to enable the firm to take advantage of bargain purchases. So all of a sudden, a great opportunity comes up, very high net present value project. You don't have time to go raise additional capital through the capital markets process. If you have cash, you're able to take advantage of those opportunities right away. one of the things that businesses need to do is provide a cash budget because, as I had mentioned a couple times in the course, if your business runs out of cash, it's a really bad day. You could be a profitable business, but because of the timing of your cash flows and the amount of your cash balance, you run out of cash. You can't meet payroll. You can't meet a required payment to a bank or other critical vendor, and pretty soon you're out of business, even though you have accounts receivable coming in, but they haven't shown up yet. And so again, cash management is going to be the most critical piece of any business operation. If you ever intend to go into business for yourself, if you're working in a business, you're going to find cash management. Cash management is your most critical skill. You're going to build a cash budget, and I'm going to walk you through Unilate's cash budget here in a minute, and you can see where some of the issues might be. And so it's a cash budget is nothing more than showing cash receipts, disbursements, and cash balances at each period. And this isn't your GAAP financial statements. This is the cash in and out. You're going to look at your target cash balance. So how much do you need to maintain for transactional purposes and reserves? And then we're going to look at the disbursements and receipts. So essentially, what do we need to pay out and what do we expect to come in and how do those things tie out? So let's take a look. Let's walk through Unilate's cash budget. So here's Unilate's cash budget based upon the financial statements. So you've got sales in these periods here, so May through December. And what we've assumed is purchases of inventory and other raw materials need to be done about 30 days in advance. So, and they're about 60% of the next month's sales. So this is your variable cost. So for instance, when you've got August of $200 million in sales, you need to do $120 million of inventory purchases in July, $150 million of sales in July. You need to do $90 million of inventory purchases in June in order to have them ready for July sales. So you can see everything is lagging at 60% of the prior month is what the purchases amount is. And then we've got essentially a calculation for how much cash is going to be coming in. And so you've got, this is the amount of current month sales, so 20% times 98%. So let's say you've got a 210 net 30 discount. So this is 20% of your clients take advantage of the 210 net 30 discount. And so they're going to pay the current month sales in the current month. So from that amount, you're going to get $29.4 million of cash in July. Previous month sales, 70% people pay it net 30. And so that's $87.5 million, which is 70% of that 125. And then 10% of the 2 months previously. So some people pay late. And so that's 10% of the May sales. So in July, we have sales of $150 million. We have receipts. So we sold $150 million, but we only collected $126.9 million in cash. Some from this month's sales, some from last month's sales, and some from May's sales. And we purchased $120 million worth of raw materials for getting ourselves ready for August's sales amount. So now we start timing out our cash flows. So we know what comes in. Now let's figure out what's going out. The $90 million that we purchased in June to pay for July, we're going to pay that vendor in July. So we're paying them at net 30. So we're going to pay for purchases 1 month after purchase. So you can see that these are all paid the month after the purchase is made. Wages are paid essentially in the current month, and it's 22% of the current month sales. So in this particular, in Unilate's case, you've got a mercifully completely variable wage amount. That's driven by the sales amount, and it's fixed at 22%. So we're going to put that in there. But you can notice that when you have a high sales amount in a month, you're going to have a high wage amount in that month. But as we go back here and kind of giving it away, you can see that the cash collected in September, even though we have high wages, the cash collected is actually relatively low. And so we've got a pretty heavy call on cash in September. So you've got wages, you've got rent. Rent's a fixed cost at $9 million a month. You've got other expenses, and this is probably tied to the sales based upon kind of just eyeballing it here. You've got these other expenses. You've got taxes due on a quarter. So September and December, we have taxes due. And then we've got a payment for plant and equipment. And so that's going to be for property, plant, and equipment. We have a $20 million debt payment due in October. And so we sum all of our cash disbursements up and we say, okay, total disbursements in July is 139 million, 181 million in August, 241 million in September, and so on. So we take the total cash receipts in each month, which we calculated on the first schedule, the total disbursements from the schedule we just calculated back here, and we come up with the net cash flow for the month. So we have negative 12.1 million in July, negative 24.3 million in August, negative 37 million in September, and then October, November, and December, we see positive cash flow. We started with $8 million in July. So if we run down July, we've got a $12 million of negative cash flow. You've got $8 million of cash, so we had a negative ending cash balance of 4.1 million. We have a target cash balance of $5 million. So we've got a cash shortfall of 9.1 million bucks. As a matter of fact, when you look at this on a month-to-month basis, you see that we actually get to the point where we have a cash shortfall of $70 million in September because we have high sales, high manufacturing in September, but that cash doesn't start showing up until October. October's cash starts showing up in November. And so you can see that there's a delay in cash, but because we have expenses associated with producing all that equipment or all those items for sale, we have a significant cash shortfall. So what we're going to need to do is figure out a way to finance this $70.4 million. It's actually going to be more than that because as you look through here, we're building up a significant ending cash balance. So, you go down here and you go, okay, this comes to 4.1 million. Your beginning cash balance goes to negative 4.1 million. You got minus 28.4. So your cumulative is $70.4 million. We're going to need to finance. We probably need to find somewhere around $75 million of short-term financing that we're going to be able to use to bridge through this period until we can pay it back out here. So there's a few cash management techniques we can use to try and time this thing up. You got synchronized cash flows, which are, cash inflows coincide with cash outflows. So that allows the firm to hold low transaction balances or low cash balance. You've got check clearing. So that's the process of transferring funds from the check writer's account to the check receiver's account. So you've got some float associated there. So when you send a check, you write the check and it immediately on your bank account, it immediately drops down. So you say, okay, I got to pay this at net 30. You send the check on the 30th day. It is received a couple days later by your vendor. Your vendor then has to receipt that check deposited in their bank, and then that bank has to then send the check back for collection and get the collected funds. That may take 2 to 5 days. So you may have a few days of float, which is the difference between the balance shown in the checkbook and the balance shown on the bank's records, where the money hasn't left your checking account yet, but your client has received the check or your vendor has received the check and is waiting for the money to get into their bank account. You've got disbursement flow, which is the value of checks that have been written and dispersed but not cleared through the banking system and not deducted from the bank account. That's what I just talked about. You got collection float, which is checks that have been received and deposited but haven't been credited to the bank account. And then you've got net float, which is disbursement float minus collection float, which is your checkbook balance minus your bank balance. If you're on the receiving side, you may want to take a couple steps in order to accelerate your receipts. So there's things called a lockbox, and a lockbox reduces float by having payments sent to post office boxes that are located both near the customer and directly to the bank. So you may have customers all over the country, and you may set up a lockbox in Los Angeles, one in Seattle, one in Dallas, one in Chicago, one in New York, and one in Tampa. And each one of those, when you bill your customers, you will have them send their checks to the lockbox closest to them. That may reduce delivery time by a day or two in the mail. Additionally, the lockbox is going to be picked up by the bank and deposited that same day. So you now no longer have to wait 24 hours because the mail shows up in the afternoon and then you take the checks to the bank the next morning. or you put them through the check scanner and they clear the next day, the bank will automatically pick those up and deposit them for you. So there's faster check clearing within the same Federal Reserve District, so that takes a day out of it. The bank, you reduce bank handling, and the mail delivery is faster. Of course, you're going to pay for that. So there's going to be, banks will happily set up lockbox arrangements for you, but you're going to pay for the privilege. There's other things called pre-authorized debit systems, which essentially, then you may have this if you've got a gym membership or something where you say, okay, I'm going to authorize you to debit my account every month for, my gym membership. That's one way to reduce your accounts receivable and accelerate your receipts. Concentration banking is another technique where you essentially have, as I had mentioned, if you've got those lockboxes, let's say, and you've got 6 of them, you may use concentration banking where you essentially go to take the money out of each of those 6 bank accounts, concentrate it into one operating account every day, and that effectively pools your cash and allows you to utilize it more effectively. Sometimes you're going to have, on the disbursement side, you're going to have payables concentration. Payables concentration is going to be similar in that you're going to accumulate your payables and pay them all, at a significant or at a single point in time. We talked a little bit in the last chapter around zero balance accounts. Zero balance accounts is a disbursement account, checking account that always maintains a zero balance. And if you need additional funds, so it overdraws, you make your deposits into your ZBA and your checks clear against your ZBA. And the bank looks at the net balance. So it looks at your daily activity and it says, okay, did you deposit more money into this account than you withdrew? If you deposited more money in the account than you withdrew, it either uses the excess cash and sweeps it against your line of credit or sweeps it into a savings account if you don't have a line of credit. And then if the amount is negative, it'll either sweep money out of your savings account or sweep money out of your line of credit to cover any outstanding checks. So it's essentially your checking account is always a zero, but you are sweeping against either a savings account or a line of credit for any excess or deficiency. Controlled disbursement accounts are checking accounts where funds aren't dispersed until the checks are presented for payment on a daily basis. So you will essentially, the bank will send to the business a file of checks and say, here were the checks that were presented to the bank for payment. Can you approve these checks? Essentially, authorize their payment. And so it's not only a timing of cash issue, but it also is a security issue. For marketable securities, which is kind of next down on the liquidity, those are securities that can be sold on short notice, generally without loss of principal or the original amount that was invested. So those are generally going to be things like certificates of deposit. They're going to be money market funds. They could be short-term bonds, treasuries. There's generally little risk associated with them. They're a substitute for cash balances, but they give you a little bit more interest, and they're temporary investments. So you might use them to finance seasonal operations or cyclical operations. So you've got an excess of cash in December, but you're going to be short in January and February. So you set that aside, you put it into marketable securities, and then you draw it out of the marketable securities when you need it in January, February. And you also can put things in marketable securities where you need liquidity, but you're going to need them in the near future. So you might be saving money to build a new plant or to buy additional equipment. And so you set the money aside in marketable securities so it earns a little bit of interest while you're waiting to make that large purchase. There's a few characteristics of marketable securities: short-term maturity, low risk, very liquid, low yield, because risk is low. Again, principle. If the risk is low, you're going to get low returns. If the risk is high, you're going to get high returns. So the yield or the return on marketable securities tends to be low because the risk is low. There's very few free lunches, especially in finance. And so if you see low return, it's generally low risk. If you see high return, it's generally high risk. When we talk about credit and credit policy, we're now moving down into accounts receivable. The firm's credit policy is the firm's credit standards, credit terms, methods used to collect, etc. Any company that issues credit. And issues credit doesn't mean a credit card. Issues credit means you allow somebody to pay you later and not pay cash at the time of sale or service. You need to have a credit policy so that you and your business understand what the rules of the road are, the customer understands what the rules of the road are, and you follow that policy. Credit standards are the minimum financial strength a customer must have to be extended credit and how much credit you'll extend the customer. It's a good practice to have credit standards and credit application, including references and reference checks, because again, you're going to want to know where the customer's bank is. You're going to want to know who else that they're doing business with. Do they pay on time? Are they a good customer? Credit terms are the payment conditions offered to credit customers, length of credit period, and any cash discounts offered. So again, you may have things like 210 net 30. You may go net 45. You may have credit terms that say if you're late after 60 days, we're going to charge 1.5% per month interest. Those are all your terms. Your credit period is the length of time for which credit is granted. And after that time, the credit is considered delinquent. Normal companies are 30 days. Cash discount, we saw the power of a cash discount. That's a reduction in invoice price for goods making a payment before a certain date. And then collection policy is what are we going to do if someone doesn't pay? So how do we go through a collections process for our receivables? The process of evaluating the credit policy and payment patterns to determine whether there's been any changes in customer payment patterns and whether a customer is going bad or not is an important part of receivables monitoring. So on a regular basis, you should be looking at your accounts receivable aging and seeing if any of your customers are starting to slow down their payments or they're not paying like they used to. That may indicate one of two things. One, they may have lost an invoice. So if they're always paying good and they always pay on time and all of a sudden they're late, they may have missed an invoice. It might have gotten lost in the mail. There might have been someone on vacation. It might have gotten thrown away. So you are going to want to follow up. Also, it may be that business was doing well and all of a sudden isn't doing well. Something's changed. And again, if something's changed, you may need to look at their credit policy and their credit standards and see if you need to make modifications to their account. We talked a little bit about day sales outstanding. That's the average length of time required to collect an accounts receivable. It's also called the average collection period. We calculated that in the last chapter. The accounts receivable aging schedule is a report. Generally, it's by client that shows how long accounts receivable have been outstanding, and it shows the proportion of receivables that are current and the proportion that are past due for given lengths of time. I always recommend that if you're in finance or operations, that you, on a weekly basis, take a look at your AR aging and see if anything's kind of getting old. And on a monthly basis, you should be reviewing it if you're in the executive role with your finance team or your bookkeeper. And if you are the bookkeeper, you should be looking at it weekly and coming up with a methodology by which you're going to make sure that those accounts are getting collected, especially those that are getting older. So a typical AR aging looks like this. You'll see it aged out normally 0 to 30, which is current. And then you've got 31 to 60, which is delinquent. This is delinquent and delinquent. Over 90 starts getting to be where it's really questionable whether those will ever be paid. And you start looking at reserves once you get up into this level here. You have to have a bad debt reserve for this 10% of AR that's sitting out over 60 days. But I would be looking, if I was in a controller situation or a bookkeeper situation, I'd be making sure that these guys are all being followed up with and that they're paying. I would have a plan that is looking at whether I'm ever going to get paid on these over 90s and maybe sending those off to collections, whether to an attorney or commercial collection agency. And a 61 to 90s, I'd be actively working to see whether there's been a change in the condition of the company, whether there's an issue with the invoice, etc. But you can see in this particular case, the average days outstanding for each tranche or each group. And so the DSO, 40% is at 18 days average, 50% is at 55 days average, 6% is at 77 days average, 4% is at 97 days average, for a day sales outstanding of 43.2 days, which again, as we talked about, we'd like this to be closer to 30. So once you're getting up into the 40s, you're starting to get long in the tooth, and you probably are going to be running into a cash flow crunch, which we saw on Unilight's cash budget. So when you're going to make potential changes in credit policy, we come back to the combination of risk, return, and time of cash flow. So we're back to finance principles. Marginal cost and benefits. So if you're going to relax your credit policy, let's say, and issue more credit to folks, you're going to have marginal cost and marginal benefits. You're going to have changes in sales. So sales should theoretically go up. You're going to have changes in variable operating costs because you're going to be producing more. You're going to have changes in average collection period that might stretch out a little bit, and you're going to have changes in carrying costs of receivables because that might be getting stretched out a little bit. And these variable operating costs need to be paid maybe sooner than the collection period, which starts making you look like the Unilight's cash budget, where there was a timing issue and they need to come up with about $72 million, $75 million worth of financing to bridge that gap. Proposed changes should be evaluated the same way as you would do a capital budgeting process. We're taking a look at the net present value of the changes in the cash flows under the proposal versus the existing. And if the net present value is positive, you proceed. If it's negative or zero, you don't. And that's so we're back to capital budgeting techniques and analyzing these changes in terms of cash flow and figuring out what the timing of that cash flow is to determine net present values. For inventory management, once you move past AR, the next biggest trip and maybe one of the most challenging for most businesses is inventory management. Inventory is comprised of three buckets. You've got raw materials, so that's inventory purchased from suppliers that are transformed into finished goods. You've got WIP, work in process, which is inventory in various stages of completion, but not ready for sale yet. And then you've got finished goods, which are inventories that have completed production and are ready for sale. We're going to do a little bit of math in this chapter, and that's around optimal inventory level and economic order quantities. You'll probably get a lot more of this in an operations management course. But because inventory is such a critical piece of the balance sheet and such a significant current asset, we're going to touch on it here. The optimal inventory level is to maintain the lowest possible amount of inventory and still be able to sustain operations. Inventory has essentially a couple costs associated with it. You've got carrying costs, which is the cost of holding inventory, such as storage, insurance, use of funds that are just sitting there tied up in inventory on the shelf. You've got ordering costs, which is the cost of placing an order, and the cost of each order is generally fixed regardless of the size of the inventory. It takes a certain amount of time for your purchasing department to put a purchase order out, send out the order, receive the order, inspect the inventory. The other thing that isn't noted here is the cost of obsolescence. So over time, inventory can become obsolete or spoil, and so that's a cost associated with carrying inventory as well. So total inventory costs are your total carrying costs plus your total ordering costs. Your total carrying cost is a carrying cost per unit, and then you're going to multiply the carrying cost per unit times the average units in inventory, so units at the beginning, units at the end, divided by 2, plus the cost per order times the total number of orders, so the number of the number of orders divided by Q divided by the quantity, and that's going to give you your total inventory cost. The economic order quantity is a relatively complex formula, but just don't freak on it. Just kind of plug along, and you'll be given all the inputs and just plug them in. But it's the optimal quantity of inventory that should be ordered, given all those factors. So you're looking at all these factors here, and you're going, okay, how do I optimize this? Well, there's a formula for that because it's finance, and so it's the quantity that will minimize total inventory costs over time. And so the EOQ, economic order quantity, is a formula for determining the order quantity that minimizes total inventory cost, maximizes profit. The EOQ is the square root of 2 times the cost per order times the total demand in units over the carrying costs times the purchase price of the inventory. And you're like, how did they come up with this? You don't need to worry about how they came up with it, but you do need to know how to calculate it. And so again, if you're going to calculate this, utilize your mathematical order of operations. So you're going to do this and this first. You're going to solve for this equation and then take the square root of it. That's going to give you your economic order quantity. And it's going to tell you how many units you should order each time you order them. We're going to walk through an example. Jowden Manufacturing sells ovens that cost $320 to purchase and prepare for sale. Annual sales are 50,000 ovens. Carrying costs are 40% of inventory costs, and Jowden incurs a cost of $500 each time an order is placed. What's the EOQ for the ovens, and what will be the total inventory cost if the EOQ amount is ordered? So, pretty typical problem. Let's walk through it mathematically. So the purchase price is $320 per oven. The demand is 550,000 ovens. Carrying cost is 40% of the purchase price, and fixed ordering cost is $500,000. So when we look at the EOQ, you've got 2 times 50,000, which is the demand amount, times the fixed ordering cost of 500 over the inventory carrying cost 40% times $320 per oven. So you've got $50 million worth of value here over 128. The square root of that, this comes to $390,625. The square root of that is 625. So 625 is the order point is what you order. So every time you go to order ovens, you order 625 ovens. And then there's going to come a point where you calculate what stock out looks like and when are you going to run out, and that's when you order your next 625 ovens. So at total inventory cost at EOQ, you got 625 divided by 2 because you're going to have an average number of ovens at 320. So you're going to have an average number of ovens times 320 times 0.4, which is the inventory carrying cost. So 50,000 plus 50,000, which is the total number of ovens, over 625, your EOQ times 500. So again, you're going to get a total inventory cost of 312.5 times 128 plus 80 times 500, which is 40,000 plus 40,000. So 80,000 is your total inventory costs. So you've got some EOQ model extensions. So these are points, these are other things that you need to factor in when you get to a complex EOQ calculation. What's the level of inventory at which an order should be placed? So what point are you going to stock out? Safety stocks, what additional inventory do you need to carry to guard against changes in sales rates or production shipping delays? So all of a sudden sales start going up and you would assume that sales were going to be flat at that $50,000. What if sales start going up? How much do you have to have in safety stocks, essentially a buffer inventory? And then quantity discount. Is there break points if inventory is ordered in large quantities, and that may change the economics? And again, we look at things based upon net present value. And so these are elements that can be factored into a net present value calculation. For inventory control systems, you're often going to see a red line method, which is an inventory control procedure where a red line is drawn around the inside of an inventory bin. And once the inventory drops below the red line, that's when you reorder. That is how, when you look at Japanese, the old Kanban system, and the original just-in-time systems, they tend to be driven around this red line method where you would be able to take a quick look and determine whether you had enough inventory. You would essentially physically mark out where the reorder point was, and once you saw the reorder point hit, it would trigger someone to order the inventory. You can also use an inventory control system, which is now very common. It's an inventory control in which a computer is used to determine reorder points and to adjust inventory balances. So all the calculations we just went through, will be done by computer, and they're going to and a computer will take a look at it depending on the programming and say, okay, based upon our current sales level, the economic order quantity that we're calculating based upon today's current costs and today's carrying costs and interest rates, etc. This is what we're going to. This is when we're going to reorder. Most businesses have moved to a just-in-time system. Just-in-time is a system of inventory control where a manufacturer coordinates production with suppliers so that raw materials or components arrive just as they are needed on a production process. So, for instance, if you're manufacturing a car, you're going to have the wheels for the car arrive as the car is getting ready to come off the assembly line. You don't have a stack of wheels sitting there waiting to get put on cars. You may have wheels enough for that day's production, and that's it. And every day, the supplier of the wheels is going to bring the wheels to the auto manufacturing plant, and you're going to assemble the car and bring the wheels in. At the same time, we're bringing, perhaps the seats in are going to come at the same time, and you're going to maintain maybe a day or two worth of inventory. Outsourcing is the other piece, which is you can purchase components rather than manufacturing them in-house. This is done far more often than not. So Apple doesn't do a lot of their own production. They actually outsource the bulk of their production to companies in China. And so as a result, they outsource their production, and then they bring inventory in when they need it, and they take possession of it as needed, but they put the inventory risk and obsolescence risk often on the outsourcing partner. When you look at multinational working capital management, you got a couple elements to think about. You got to think about the speed of collections and the speed of disbursements. You're going to want to be able to shift cash rapidly as possible to those areas where it's needed, which may be overseas. You've got exchange rate risk associated with that as well, so you're going to want to be keeping track of cash balance or your cash budget for each location and making sure that you've got that dialed in. Because you may need to move cash from one jurisdiction to another jurisdiction. You're going to want to put temporary cash balances to work, earning returns in each one of those locations, just like you do in the domestically. For credit management, credit is more important because the United States has a very well defined and robust court system. The other countries, that's going to vary country to country and may be very favorable to the locals versus the international firm that you work for. So credit policy is going to be very important because the risk of default is generally greater. Political and legal collection constraints may make it very difficult for you to collect even if you are in the right legally. And exchange rate risk, the exchange rates can change over time, and you may have underwritten based upon one current set of assumptions and the exchange rate changes. And so you can end up losing or making a bunch of money on exchange rates. So collection and getting it transferred into the currency into which you're going to be paying the bulk of the expenses for that location is absolutely critical. From an inventory management perspective on working capital management internationally, you're going to want to focus on, do you concentrate the inventory in one location and ship it? Or do you distribute the inventory out to the various locations where it's going to be used? And the costs are going to be different. But if you have it distributed, it's generally going to be delivered quicker. If you have it concentrated, it is going to take longer to ship, but your cost of inventory is likely to be lower. Your cost of storage is likely to be lower, and you may have better control. Exchange rates will impact inventory. And so you may see, especially if you have raw material inventory, that may be dramatically impacted by changes in exchange rate or commodity rates. You have threats of expropriation. So again, I had mentioned a couple classes ago, you have countries like Venezuela seized a lot of foreign firms, and as a result, they expropriated or took the inventory of those firms, including things like raw materials inventory and oil reserves. And so you always have a threat of expropriation. So making sure inventory is minimized may be in your best interest if there's a high political risk. And then tax effects. Some countries, including the United States, will tax property, including potentially inventory. And so the higher your levels of inventory, you may see that you have taxes due. And so that's just something to keep in mind and to manage as you're looking at working capital management internationally.